Hey, old dogs. I just want to take a moment to welcome a new sponsor to the show, Smart Move. Smart Move is the best way I know to protect yourself from evictions and bad tenants. Smart Move has a special offer just for old dog listeners. Just go to tenantscreening.com, enter code OLDDOG25 at checkout, and you'll get 25% off your next screening. That's tenantscreening.com, enter OLDDOG25, and get 25% off your next screening.
This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got a great show for you today. I'm really excited about it because this is an area that I really don't think we talk about enough, because it's one of these areas where, you look at real estate and go, God, this is a great area to be in. And that's in the Section 1031, or the 1031 exchange, as many people know it. The gentleman we have on is an expert in that area. They're talking about Michael Lantrip. Michael is an attorney at law. He's licensed to practice in Texas, North Carolina, Virginia, and the District of Columbia. He is also admitted to practice in the U.S. Tax Court and the U.S. Federal District Court, Eastern District of Texas, and the D.C. Court of Appeals. He has a BBA in finance from the University of Houston School of Business, and he has a Juris Doctorate in law from the University of Texas School of Law. He practices in the fields of tax law, real estate law, corporate and business law, and wills, trusts, and estates. And also, he's been a criminal defense attorney, where he has taken 3 cases to the Texas Court of Criminal Appeals, winning 2 of them. As a county attorney, he handled almost 2,000 misdemeanor criminal cases. Formerly a tax examiner for the IRS and a tax accountant for a Big 8 accounting firm, he has also been a newspaper reporter, radio announcer, radio news director, television reporter and anchorman, television executive news producer, and military intelligence analyst. I mean, this is amazing how much stuff this guy has done. In addition to 35 years of practicing law, he built one of the first computerized abstracts plant and operated his own title insurance company, and has been approved title attorney for 7 national title insurance underwriters. He has handled over 2,000 real estate closings. And as a real estate investor, his activities have ranged from travel trailers to office buildings, and from on-campus condos to hundreds of acres of land. Prior to his law career, as we mentioned, he was a radio announcer, but he was a radio announcer at WQTE in Detroit during the Motown era. Okay, now we're talking my time here. He was a DJ at KIKK in Houston. Okay, went from Motown to country here. Named Country Music Station of the Year, the station he worked at, by Billboard magazine. He has written over 700 stories as a daily newspaper reporter. He has written and produced more than 1,000 half-hour television newscasts, has logged over 8,000 hours on the radio, was named a top writer 2018 by Quora.com, and is a lifetime member of Mensa. All right, can I just rest for a second here? Oh, my goodness. And I didn't mention all the books that you have also published, too, on top of that. Well, man, oh, man, Michael Lantrip, welcome to the Old Dogs REI Network.
Thank you, Bill. I got tired just listening to that.
I'm telling you, man, oh, man, I go through that, I go, wow, this guy, he's got to be an old dog because he's got way too much history here.
Well, let's get that out of the way right away. I'm 80 years old.
No way, Michael. Wow. You are an absolute anomaly here. I mean, gosh, you've got the attorney side, you've got a CPA, you've got all this other stuff in here, put together in addition to your sort of entertainment industry experience. I mean, wow, this is quite a background, and we're glad you could be with us today.
Thank you, Bill. I appreciate it.
I know we just zeroed on one little area here. Now, me personally, if I had my choice, we'd sit around and talk Motown here, okay? So, but we're a real estate show, so we found an area, one of many in your expertise here, and that is the 1031 exchange. And so I am real excited to hear about that. But before we get started, I'd just like to hear just a little bit, we gave a lot of your background there, but we'd like to kind of hear how you, kind of moved into this real estate area on top of everything else that you're doing.
Well, I am not really in the real estate area as an investor by myself. I have my own investments, but my connection to the real estate investing is as an accountant and as an attorney. My clients do it. And so most of the participation that I've had is when they come in with a deal that they are ready to do, or they come in with property that they already own, and I do their tax work for them and so forth. So I'm that, what they call, member of the team that does the legal, the tax, the accounting, and all of that. Although I have had a number of investments, and I'm divesting myself right now of those because I'm in a transition period where I'm moving from Texas to the North Carolina, Virginia, D.C. area.
Ooh,
and so unlike you, I'm not comfortable with long-range investing. I've been burned once on that, and so I'm selling everything here before I start over there. So that's where I'm at.
Well, that makes sense. Well, Texas is one of the hottest places in the country to invest, or at least it has been for the last 5 years that I know of. It's just been on fire. I don't know, what part of Texas are you from?
Eastern part. It's not too bad here. We're in the Great Piney Woods of East Texas. It's beautiful.
Beautiful country over there. Yeah. It's not your typical Texas, where you think of the big sort of desert terrain, it's very beautiful over there.
No, it's not West Texas. And I worked in Albuquerque one time, and the popular saying at that time was, I spent a year in Albuquerque last month. When you get out in the middle of nowhere and there's nowhere to go, and it's just nothing but hot and sand and lizards and cactus, that's a different world.
Wow. Well, it's interesting how you kind of landed in the area that you're in. I mean, you could have gotten you've done everything. It sounds like the criminal defense side of things. You've wills, trusts, and estates. I mean, you could have probably stayed in any of those areas, but to not only have the expertise on the legal side, but you have the accounting side, and to bring those into the real estate arena. Wow, I wish I would have known you a few years ago. Man, oh man.
My rule has always been, and it's kind of selfish, but it's worked for me. Find something you like to do that you have some ability in, and do it. And when you stop enjoying it, do something else. And that accounts for all of the things that I've done. I'm in probably my 7th or 8th profession right now, simply because of that. Because, professions change. And generally, if you enjoy them when you got in them, 5, 6, 7 years later, it's a different decision. So, like I say, it's been a little bit selfish, but that's what I've done, and it's worked out for me.
Yeah, it like reads like, wow, newspaper reporter, television show producer, a radio announcer, TV personality. All these things. It's like it sounds like you've had a very full life. It sounds wonderful. Now, the question is, though, are you ever going to retire? Probably not, huh?
Oh, no.
You don't sound like a guy that has any interest in retiring whatsoever.
And in fact, that's how I got the next book that I'm writing. As I said, I'm in a transition period, and I'm starting over after I moved to the North Carolina, Virginia, D.C. area. And I thought, well, what do I want to do? And so I said, what are the areas of real estate investing besides buy and hold? And I did some research, and I discovered that there are about 10 that you just don't hear people talk about. So my next book will be called 10 Other Real Estate Investments You Could Do. And it covers a lot of areas, and I'm looking into all of those myself as well as finishing the book. Hard money lending, used mobile homes, raw land development, storage units, billboards, and a couple that I don't think people have been subjected to, like Section 121 real estate investing. So,
what is Section 121 real estate?
Section 121 is the section that allows a person to sell the residence that they've been living in for at least 2 years out of the prior 5 years and pay no taxes on the profit.
Wow.
So, but here's how it connects to real estate investing as a business. You can also, let's say you buy a residence, you live in it for 2 years, and then you move out and you rent it out for 3 years. It's a rental property. As long as you sell it within a 5-year period of the time that you bought it, you still can exclude all of the capital gains on it, even the 3 years when it was a rental property.
Wow, I didn't even know about that.
It's one of the chapters in my book, How to Do a Section 1031 Like-Kind Exchange, but I've wanted to expand on it since then because now you do have to pay the depreciation recapture tax on the depreciation that you claim during the 3-year period, but that's all you have to.
Wow.
And when you move out of it after 2 years, you can buy another residence. You can live in that for 2 years, move out of it, and buy another one. So you have, at that point, you've got 3 residences running on this 5-year period. So you can sell one of those rental properties every 2 years and avoid all capital gains tax for the rest of your life. If you want to do Section 121 investing, it is a very viable business.
Wow, it's almost like flipping, but sort of longer term.
It is, and as a matter of fact, if you don't want to sell it you don't want to give up ownership of it after 5 years, you can set up a corporation, elect subchapter S status, and sell it to your own corporation and continue to operate it in the S Corp entity.
Interesting. Wow.
So you can keep that original house forever, and you end up with a portfolio after 30, 40 years worth millions of dollars.
Man, oh man, we may have to have you back to talk about this one.
It's one of my favorites. Section 121, of course, is my favorite because you get to avoid all capital gains tax. Section 1031 is my second favorite. And when you put those two together, it's just amazing what you can do.
Winning combo. Yeah, man. Well, let's roll up our sleeves if you're ready, and let's talk about that 1031, because I know that this is an area that a lot of people hear about, and some of them say, well, I don't know if I want to have to do that. There's a narrow window, and there's a lot of issues. And I thought it'd just be great if you just kind of clarify exactly what it is, and what are some of the attributes, what are the advantages, some of the things that you can do with this.
Okay, I think we'll probably start with the statute itself because it's not complicated. It's easy to understand. There are some words in it that have different meanings than the common definition, but the statute itself says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, what that means is that you sell your property, use all of the net sales proceeds from that sale to buy another property, and there's no capital gains tax to be paid. The gain is deferred. It's rolled into the property that you buy, and it's there. It doesn't accrue interest. There's no penalty. There's nothing. It's there until you sell that second property, and you can do another 1031 when you sell that second property, and you can delay it forever.
Wow. Now that it kind of sort of begs the question, if somebody, passes away and they have that property, do the people that inherit that property have to pay that capital gains?
That's one of the good parts about dying.
One of the good parts, I like that.
You get what is called a stepped-up basis. In other words, if you die and you have these properties that you've been deferring the capital gains tax on, and let's say you have $1 million worth of them, you leave the property to your heirs. Your heirs don't inherit your basis in the property because your basis in the property is probably very low, or properties. The basis in the property when it goes to your heirs through your probate is the fair market value of the property on the date of death. So although your basis in the property might be $180,000, fair market value is $1 million, your heirs receive that property with a basis of $1 million. If they sell it within a 6-month period where they can claim that it has not gone up in value, then they have zero capital gains on it because their basis is $1 million, what they received it through probate as, and they sold it for $1 million, and that $1 million is without capital gains.
Wow, that's great. That's great. Well, tell us, just a little bit of some of the some of the aspects of the 1031, because one of the things that I always heard about early on is, I was going to exchange my multifamily property for a commercial property, but they said it's not like kind. So maybe you can help sort of clear up some of those, or at least clarify, some of those aspects.
Yeah, the term like kind, the IRS, and I criticize them even though I worked for them and loved it, some of the best people I have ever worked with. The IRS will just make up words and insist that everybody accept their definition of them. And it's necessary for them to do that. They have to establish control of everything. And the word exchange does not really mean exchange. It really means that you're replacing one investment property with another investment property. It doesn't mean that you are trading them.
Okay.
And so that confuses people. So think of it as your portfolio, and you are selling one of the items in there, and you are replacing it with another item. That's the 1031. It's not an exchange. You didn't exchange that one for the one that you're bringing into it. You're exchanging the portfolio items. And like kind doesn't mean physically like. It means the same type of business character. So if it is business or investment property that you sell, then you must replace it with business or investment property. That's all. Now, we used to have more confusion when personal property was part of the Section 1031. It no longer is. The tax code was changed in 2018. The new Tax Cuts and Jobs Act changed the word property in Section 1031 to the term real property. That's all they did. Now, that eliminated personal property from Section 1031 exchanges. And I don't mean refrigerators. I mean art collections, airplanes, farm equipment, that type of personal property. Personal meaning that it's not real estate.
Okay. So could you, for example, sell a property, sell an apartment building, and then take those funds and buy a business franchise, let's say a McDonald's or something like that, because they're both business enterprises, right? Would you be able to, would that be allowed?
I think the business enterprise would be a business rather than real property.
Oh, okay. Gotcha. So you're saying you couldn't do that? You couldn't buy a franchise with the money from the sale of that and still be under the 1031 exchange?
I think you probably could.
Oh, you could. Okay.
But it's not something that I would recommend.
Right. Okay. Well, that's good to know. Well, tell us more. You've got like 10 different items here that I don't know if you want to hit all of them or you maybe handle that however you'd like.
There are no actual written down rules for Section 1031, but there are certain rules that have just come along. They've been promulgated. They have come from the statute, from the revenue rulings, from private letter rulings, and so forth. They've just been created like MOPSI, and they are generally easy to understand. They are definite rules. There are no exceptions to them. One is that both properties must be business or investment properties, and we just covered that. The second is that replacement property, and replacement property is a property that you buy. The property you sell is called relinquished property. The replacement property price must be equal to or greater than the sales price of the relinquished property. If you sell a $200,000 duplex, then the property that you buy, your replacement property, must be at least $200,000. It can be more in order to do a totally tax-deferred exchange. Now, you could buy a property for less, but you would pay taxes on the difference in the price. But we're talking about a totally tax-deferred exchange.
Gotcha. Okay.
And you can buy two. You can sell a duplex for $200,000 and buy two rent houses for $100,000 each, or four rent houses for $50,000 each. You must reinvest all of your net sales proceeds, and the total of all of your replacement property value must be equal to or greater than the sales price of the relinquished property.
Okay, and I'm just kind of skipping back a little bit to number one was it could be a single family home, could be a mobile home, as long as it is a rental property, that would qualify it?
Mobile homes are handled differently in every state. Every state has their own state laws concerning mobile homes, as to whether they are personal property or real property.
Oh, okay.
For instance, in Texas, a mobile home is personal property. However, there is a process whereby you put it on the land and you file a declaration with the state saying, I am declaring this to be real property. At that point, it becomes just like a brick or stick house built on the property. So it depends. If it has not had the title surrendered, has not been converted to real estate in states where they have that distinction, then no, you could not buy it. That would be an example of personal property no longer being in Section 1031. But as for the type of property, they're all the same. Real property is virtually all like kind.
Gotcha. Okay. Got it.
With this distinction now, and a lot of people overlook it, the real property that you sell must be business or investment property, obviously, to satisfy Section 1031. But Section 1031 says the property you acquire is to be held either for productive use in a trade or business or for investment. So at the time that you buy it, it's not business or investment property. It doesn't have to be. You can buy someone's personal residence as replacement property. Well, it's not business property, but for you, it is to be held for. And so you then have to satisfy the second part of Section 1031 by making sure that you do hold that property.
Gotcha.
As business and investment property.
All of your net sales proceeds from the sale of your relinquished property must be used in the purchase of your replacement?
Yes, that's correct. If you're to do a totally tax-deferred 1031, defer taxes on all your capital gains. Now, you can buy a replacement property for less than what you sell your relinquished property for, but you really don't want to do it. And here's one of the reasons why. If you sell for $200,000 and you buy a property for $180,000, then $20,000 of your net sales proceeds will be subject to taxation. And here's the problem with that. You will owe your capital gains is made up of two elements. Your regular capital gains, which is the difference between what you paid for the property and what you sold it for. That's just capital gains. There's another portion, your depreciation, because since you bought the property, say you bought it for $100,000, you claim $20,000 in depreciation, and then you sold it for $200,000. Instead of having $100,000 capital gains, you'd have $120,000. Well, $100,000 would be regular capital gains, subject to capital gains tax, but the $20,000 of capital gains that is there because you claimed that depreciation and lowered your basis, you have to pay what's called depreciation recapture tax on just that $20,000, and that amount is 25%.
Oh, gee whiz.
When you're dealing with the IRS, they made it very clear some time ago when we're collecting a basket of taxes from you, and it's fairly common in complicated business transactions to have a number of different types of taxes assessed. They make it very clear that we're going to collect the highest tax first.
Wow.
So the first $20,000 would be taxable as capital, as depreciation recapture, and then the rest of it would be at your capital gains tax rate.
Okay, got it.
So you want to at least do buy a replacement property for at least as much as you sold your relinquished property for. I won't go into the math, but you could end up paying 45-50% on what you're trying to keep there.
Oh, gee.
Just not worth it.
Yeah.
It's interesting. Maybe we'll have time to talk about it. There is actually a zero capital gains tax bracket that people don't know about. I know an investor who sells one of his properties every year and never pays taxes on it because he is in a tax bracket that allows him to pay zero capital gains tax up to $78,000. He has no other income. He just sells these properties every year and pays no tax because he's in a zero capital gains tax bracket.
Now, how do you get into that tax bracket?
Well, you get into there by having a modified adjusted gross income, MAGI, of less than $78,000 a year and being married filing joint.
Oh, interesting. Wow.
For singles, it's $39,375. But if you're married filing jointly and you have no other income, your only income is your capital gains, and you sell a property every year for less than $78,750, you pay zero capital gains on it because there is a zero capital gains tax bracket.
Interesting. Wow.
Then it jumps to 15 and 20. There is no 10%.
Mm-hmm. Wow. That's an interesting little tip right there. Wow. Yeah. Okay, well, should we move on to 4?
Yeah. You have to buy the replacement property in the same name in which you sold your relinquished property. The deed that goes on the deed that you received title to the replacement property must be the same name that was on the deed that transferred title of the relinquished property. Now, there's one exception to that. If you are holding your property in your own name and you sell that property, your relinquished property, you want to buy your replacement property in the name of an LLC. If you set up an LLC and you choose to have that LLC treated as a disregarded entity, in other words, report everything on your personal tax return, then you can buy the property in the name of the LLC as long as it is a single member LLC and you have chosen disregarded entity status, or not chosen any status at all. The default will be disregarded entity. So title of the property must be taken in the same name that title was transferred out on the relinquished property, with that one exception.
Okay, so if I had it in my name, Bill Manicero, I sold it, and the exchanged property is something LLC. That's okay. But let's say, for example, the property is already an LLC, and I wanted to put it under a different name. So maybe I'm going to buy a property in a different state. So I already have this LLC in Texas, but I have to set up another LLC in North Carolina. Would that work?
If you were a disregarded entity in the first one and the second one, otherwise no, because the LLC is a legal entity separate from you.
Right.
The reason that you can qualify to sell property in your own name and buy property in an LLC is that these Section 1031 rules apply to taxpayers. They're not rules for real property ownership. And so as far as the IRS is concerned, the taxpayer sold the relinquished property. The taxpayer bought the replacement property, even though he bought it in the name of an LLC. As a taxpayer, he has elected to be treated as a disregarded entity. And so for tax purposes only, he is personally the owner of that property, just for application of the tax code.
Got it. Okay.
But if you have an LLC that sells property, you buy replacement property, it has to be in the same name.
Okay, got it. And the disregarded, can you define that again, what a disregarded entity is?
An LLC is something that you set up. It's a separate legal entity from you as an individual. You are allowed to then tell the IRS, here's how I want this LLC to be taxed. Unlike a corporation, you set up a corporation, it's going to be taxed as a corporation. But an LLC, the IRS says you can, if you're a single individual setting up an LLC, you can choose to be taxed as a disregarded entity. And again, the IRS using a term in a confusing manner, you're not the disregarded entity. The LLC is the disregarded entity. What you're saying is that you want the entity to be disregarded for tax purposes. I want all of the income and expenses to run through my tax form and be treated just as though I own this in my name. That's one of the options that you have. The second option is you can actually form an LLC and choose to be taxed as a sub-S corporation. Your third option is that you can be taxed as a C corporation. That's the big corporation, the one with the board of directors issuing stock and all of that. You can be taxed as a regular C corporation. And the Tax Cuts and Jobs Act just reduced that tax down to 21%. And there are some real estate investors who are now changing over to being taxed as a C Corp, because right now they're in such a high tax bracket that they are being taxed personally at a higher tax rate than the 21%.
Gotcha.
Now they can't, that presents other problems, but it's one of the options. Now, if you are not a single member LLC, if there's more than one owner to the LLC, then you can choose to be taxed as a partnership, just like a regular general partnership. There are two default classifications. If you are a single member LLC and you don't file Form 8832 with the IRS called entity selection, if you don't file anything, the default category for you as an individual will be to be treated as a disregarded entity. And if you are two-member LLC and you don't file anything, then you will be treated as a partnership. The income of that LLC will go to each of you, and you will be taxed as partners. But you can file the Form 8832 entity selection and choose to be taxed as a corporation or any other way.
Okay, and if you want to be regarded as a disregarded entity, yeah, that'd be the same form you'd use to make that designation, or
if you fail to file Form 8832, you automatically are put in the default category, which for a single member LLC is disregarded entity, and for a multi-member LLC is partnership.
Gotcha. Okay. Man, this is good stuff. Evicting a tenant can be painful and cost as much as $10,000 in court and legal fees. The best way to protect yourself from evictions and bad tenants is to screen your tenants. And the best way that I know to screen your tenants is SmartMove. SmartMove is part of TransUnion, a trusted consumer reporting agency with more than 4 decades of experience. They built an online screening service for independent landlords that delivers critical credit and background reports to you in minutes. It is a valuable tool to help you when you are trying to decide who to put into your rental property. And they can help you find your next great tenant. Only SmartMove has a credit score built specifically for rental screening called Resident Score, which can identify eviction risk 15% better than a traditional score. With the SmartMove report, you'll also get a criminal background check, eviction history report, as well as a full credit report. And only SmartMove has Income Insights, a report enabling you to analyze renter income to determine if further verification is needed. See why 9 out of 10 users recommend SmartMove, and more than 4 million landlords have used SmartMove to make better leasing decisions. SmartMove has a special offer just for Old Dog listeners. Go to tenantscreening.com, enter code OLDDOG25, and you'll get 25% off your next screening. That's tenantscreening.com. Use code OLDDOG25 at checkout for 25% off your next screening. Smart move. Reduce your risk of non-payment and evictions. This is the one item that I know a lot of folks, have issue with, and especially in today's market, which is regarded by many as sort of a seller's market, and that's sort of the time frame that you have to make this exchange, right?
Right. It, from what I understand, is becoming a problem. The market changes fairly quickly, and there is a date established when you sell your property, your relinquished property. The day that you close on that is called the exchange date, and it's critical because that starts a 45-day period running and a 180-day period running, and the IRS has never allowed exceptions to those two periods, except in times of national disaster where the government declares that there is a disaster, which happened with some hurricanes recently, but almost never happens. You can't give them an excuse and go beyond these days. Within 45 days of the exchange date, you have to identify in writing to, and they're pretty vague on this, to someone. You probably want to identify it to your qualified intermediary, whoever you've hired to handle the funds for you. 3 properties that you will buy one of, or both, or all 3, as a matter of fact. But you must, the property that you buy must be on that list. That's one thing that you can do. Identify 3 properties without regard to the value of each one of them, and without regard to the total value of all 3 together, just 3 properties. Or your second choice is you can identify as many properties as you want, as long as the total value of all the properties is not more than 200% of the value of the relinquished property. Now that one's a little bit tricky and very few people use it. There's a third one that says you can identify as many properties as you want without regard to value of each one, as long as you end up closing on properties that represent 95% of the total value of all of them. And frankly, I have no idea how you would even accomplish that. But it's one of the rules. Well, you have 3 choices. So most people identify 3 properties. Say they sell a $200,000 property and they are planning to buy a $400,000 property. They'll just identify 3 $400,000 properties that they are negotiating with the owners about, and that's what they do.
So what if those, let's say all 3 of those, don't go through for some reason, maybe in the inspection or financing or whatever the issue is. If you pass that 45 days, they don't care, right? So
that's correct.
They don't buy it again.
They really don't. But you can change that list anytime during the 45 days.
Oh, that's good to know. Yeah.
So you can keep adding other. You would need to hit that list hard, and when one starts to look like maybe not, pull it and put another one on there. But here's the deal. You back up to the exchange date. You can do some clever negotiating, and you can control this situation. You can sign a contract on a property, and I don't know, it probably depends on the market, how much flexibility there is for the buyer. You say it's the seller's market right now, you might have to give them some incentive. I don't know how you would do it. But the closing date, which becomes the exchange date, the closing date can be manipulated by you until you have absolutely locked in one of these properties.
You've got the 180-day requirement there, right?
The 45-day requirement as well. If you don't really have a property locked in to buy, then you can start negotiating on properties before you sell your property. It doesn't affect Section 1031. And you can sign a contract to sell your property and say the closing date will be whenever I say it is. And for each day or week or month that we go beyond this certain date, I will pay you this, or I will whatever. Do whatever you can to gain control over that closing date, because that's your exchange date, and that will allow you more than 45 actual days.
Is a 180 from it's the close of the sale still, right? Or is that
correct? Yeah, the 180 starts on the exchange date as well.
Got it.
But the 180, I wouldn't think would be a problem if you can satisfy the 45. If you can lock in a property in that 45 days, you have another 135 days to close on it.
Yeah, that's true. That's pretty.
I would think you can do that.
Yeah. Is there a requirement if you're buying a property that you need to tell them up front, or that you're doing a 1031 exchange?
As far as I know, there is no real estate law or property law under which a seller at a closing could do anything to derail that closing under those circumstances. In other words, it doesn't require the seller's approval. No, there is no requirement that you tell them. And if you're asking if you should, I think the answer probably you should not.
Yeah, that's what I would think too. Yeah, because that I think would definitely hurt any negotiation.
Yeah.
Got it. This concludes part 1 of The Power of the 1031 Exchange with Michael Lantrip. Stay tuned next week, Monday, August 19th, for part 2 of this exciting information-packed podcast.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.